Okay, so the wrap up for chapter 8 is the kind of comprehensive problem where we go through and record all the transactions into the accounting categories. So today's date. Okay, so the company is making some purchases again. Right, and it's settled at FOB destination. So that means when they get the materials, they become their property. So for that first one, we don't make any entry. Right now, let's see when it comes in. For the second one, we collected 11,400 of accounts receivable. So we've got 11,400 in the cash, and then 11,400 reducing accounts receivable. Paid $900 for a 3-month insurance policy beginning August 1st. August 1 sold 8,000 shares of 50-cent par common stock for 20,000 in cash. The original owner was issued 12,000 shares of 50-cent par value common stock when the company began. All right, so I'm going to ask you guys to tell me how I would enter number 4 in chat. Looking over the answers so far, pretty close. Chris hit the nail on the head. Kayla's working on it. Pretty good so far. Taylor, remember we have par value. Addie, that's technically correct, but you want to split up your contributed capital. Good, Spencer. Give me another minute. Remember, Dylan, you're selling ownership shares. Not yet, we haven't sold anything. Okay, so I'm gonna go ahead and go through the answer. I don't have any more coming through. So it said that they sold it for 20,000 in cash. And then common stock was 50-cent par value. So you're gonna have 8,000 times 0.5, and that equals 4,000 common stock. And then the remaining 20,000 minus the 4,000 is equal to 16,000 additional paid in capital for common stock. And that balances the transaction on both sides. I'm just going to bold these. Any questions there before I move on to the next one, since that's kind of the heart of the chapter? Okay. So I'm going to move on to the next part. It says Tim Stams paid back 1,000 to buy 400 of the 12,000 shares issued to Tim in January. So we have 1,000 reduction in cash. And then within contributed capital, we have $1,000 treasury stock. And you'll notice that it's put in as a reduction in contributed capital. Okay. This is August 6th, paid 6,985 of its accounts payable from July purchases. And so that reduces our cash, but it also reduces the liability. Number 7, during August, Tim Tam sold 1,400 caps at $10 each on account. Tim uses a FIFO perpetual inventory system. August beginning inventory is 200 caps at 6.35 each. Okay, so the reason that I had left number 1 open is I wasn't sure when it was going to come in, but it's clear from the information that we have that they're not going to give us an exact date that it came in. So we're just going to assume that it arrived within August. So we have to multiply the 1,500 times the 6.4, and that's 9,600. So we're going back to number 1. We have 9,600 in inventory and 9,600 in accounts payable. So here, let's record the revenue part, 1,400 caps at $10 each on account. Sorry about that, hit the wrong button there. So 1,400 times 10 equals 14,000. Accounts receivable. Then we have 14,000 in revenue. And then we have to reduce our costs, and it's first in, first out perpetual.
Don't you have to use the 200 caps at 635 sometime?
So now that's where our cost of goods sold is. So FIFO perpetual, we're going to start and we're going to use the 200 at 635. So 200 times 6.35. Take me a second to calculate it. That's 1,270. And that reduces our inventory. And the remaining 1,400, so now we have 1,200 times 6.4. $6.4 times 1,200, and that's 7,680. That reduces our inventory. And then we add the 1,270 plus the 7,680. And that's 8,950 cost of goods sold. Okay, so now we've completed that entry. Declared and paid a 10 cents per share cash dividend to all shares outstanding. So for shares outstanding, we started out with 1,200 shares. We added another 800, and then we repurchased, I think it was 400 in treasury stock. And so that gives us 1,600 shares outstanding. And so now we multiply the 1,600 times 0.10, and that equals $160 reduction in cash and 160 in retained earnings in dividends. I'm just going to bold the entry part for these two. If you had this summed up, you'd be fine. Just illustrate it out for the video, and if anybody watches later. Or maybe not. Okay, any questions so far on 5 through 8?
Where did you get the 1,200? Is that just the beginning shares that they had?
Correct. 1,200 was the beginning shares. Oh, I'm sorry, should have been 12,000. I misread that. Good catch. So it should be 12,000, 8,000, and then 400. So we'd have 20,000 minus 14, so 19,600. So this would be 1,960. Thank you, Chris. Okay. Moving on to number 9. Made the monthly payment of $1,000 on the 6% installment note. Round interest to the nearest dollar. And so we have the note payable 10,678. And it has a 6%. I'm going to make that calculation up here. And it's 1 month. So we have 1/12. And so when I make that calculation, I get 53.4 rounded to 54. And so principal would be the 1,000 minus the 54. So 946. So we have $1,000 reduction in cash. 946 reduction in notes payable. And $54 in interest expense. Wrote off $300 accounts receivable because the customer went bankrupt and is unable to pay for the sale. Made to him in July. Had a question, but round up and not down in that scenario. Let me make sure I read that. It says round interest expense to the nearest dollar. So sorry, $53. So that would be 947. Good catch. All right. So now wrote off $300 accounts receivable balance. So on this one, if we look at number 11, we have adjusting entries for uncollectible accounts. So we are making those entries, and presumably we made them in July as well. So the way number 10 would work, and we can kind of look at it here and see that we had a $500 allowance. So in our other category, we're going to have $300 that directly reduces our accounts receivable, and $300 that reduces our allowance as well. Number 11, recorded the adjusting entry for uncollectible accounts. $600 of uncollectible of accounts receivable is estimated to be uncollectible. So now we're making our entry for bad debts expense. So we have 11, and this would be $600 for allowance and $600 for bad debt expense. Found that all of the office supplies had been used. And so beginning balance of supplies equals 100 minus the ending balance of supplies, 0. So supplies used equals 100. Supplies expense. Adjusted for insurance used during the month. So we have from, I think it was number 2. No, number 3. $900 divided by 3 equals $300 per month. So 13, we're going to reduce our prepaid insurance by 300 and record a 300 insurance expense. It's recorded 1 month straight line depreciation on the $18,000 truck that has a 6-year useful life and no salvage value. So we're using straight line. I'll go ahead and put a reminder in. So straight line depreciation is your historical cost minus your salvage value divided by your useful life. And so here we have 18,000 minus 0 divided by 6. And so it's 3,000 per year. But we only need 1 month of that, so we have to multiply it by 1 divided by 12. I think that's 500, but let's just check my math. $250. All right. So for 14, we have 250 for accumulated depreciation and 250 for depreciation expense. Excuse me. So remember, I will be posting this, but if you have any questions on entries 9 through 14, okay, if there are no questions, we're going to go on to part B. So what I'm going to do here is try to get this all onto one page. Sorry, the control bar is kind of in the way. That's too small. Okay, that's good. And then I'm going to set them up to post side by side. And I'll ask you to complete part B and type your answer in the chat. Just want to drop part B down so you guys can see all of it. You don't have to enter each part. Just do, provide the answers for number 10 and number 11. You didn't have to enter them in them all like that, Spencer, but that's good. Okay, we've got 3 answers, so I'll give you another minute. Okay, so let's go ahead and put our answers in here. So we had sales, 14,000. Now, I think the only part that we have to look at is where do we record bad debts expense? So here we do report it. So 14,000 is good. Cost of goods sold. We have 8,950. So that's 5,150. We had insurance expense, 300. Depreciation expense, 250.
Isn't it 5,050?
Yes, thank you. Supplies expense, 100. Bad debts expense of 600. So that's what, 550, 650, 1250. So for operating income, I get 3,800. Interest expense, 53. And so the net income would be 3,747. And then EPS would equal net income minus your preferred dividends divided by your average shares outstanding. All right, someone's just typing to me. Somebody asked where I got sales from. And so if we look back, our sales is the 14,000 in revenue, and number 7. Okay. So our earnings per share would be 3,747. And in this case, we're going to take our average shares. So we started off with 12,000 and we ended up with 19,600. Divide that by 2. Sorry, there were no preferred dividends. Let's put that in there. So we have 3,747. $15,800. And so I get 0.24 if I round. Can't get that to move up. Sorry about that. Okay, I'm checking my questions. So somebody asked, is that pretty good EPS for a company with that amount of net income? I would say it really depends on how many shares are issued. For me, thinking about $3,700 on $14,000 revenues, pretty reasonable. And then somebody asked where I found preferred dividends, and there were none, but I was just putting the overall formula out there for you. In this case, we didn't have any preferred dividends, so I'd zero that out, but it would be on the beginning information if there were preferred shares. Okay, any questions? So that's it for today. It's kind of a review of everything we've done for the transactions. And it has our new transactions related to equity and dividends. If there are no further questions, you all are free to go. Have a great weekend, and I will see you on Monday. We'll start chapter 9. And so please prepare for the reading quiz on Monday. Have a great weekend. Stay safe.
Thank you.
You're welcome. Thank you.